Citi out with its 2021 commodities market outlook ruined my Sunday night. Thank you very much. It is a bullish Brent Dubai spread, sees restructuring for the oil sector, expects gold to reach 2,100, and says copper is just too hot to handle for now. Joining us now is Ed Morris, Citi's global head of commodities research. Ed, it was a great report. What stood out to me and the common thread throughout all the commodities was the importance of China buying. But this a little bit different than, say, in the early 2000s, that it's really going to be the long-term shift to decarbonization and restocking that's going to make the thesis fundamentally for the commodity world.
Yes, that's exactly right. China remains, the center of the commodity world, and they're stepping it up by the decision they made at the last Party Congress to really ramp up strategic stockpiling across all the things that they're dependent on, and that's just basically everything.
Right, and part of that then becoming that decarbonization story as well. So if they're buying everything, how do you know which ones to get bullish on, when, where, how, and why?
Well, we try to look at the entire market globally and think about what's happening globally. We have a view of the oil market, where the oil market, they're not as dominant as they are in the copper market. They're pretty important. They're buying a lot, not just for stockpiling, but for other things as well. And we see inventories drawing down quarter by quarter by quarter through next year, and that makes us positive. That one. On copper, we think the decarbonization is a copper story basically for the world as a whole. There's been a little bit too much exuberance on copper buying by the speculative community, particularly in the last couple of months. So we're looking at buying dips there, but for the longer run, we see copper prices being fairly robust, along with other.
Ed, good morning. Ed, good morning. It's Guy. How much of the vaccine news is priced into the commodity complex?
A lot of it was priced into the commodity complex in the last month. Some of it hit copper, some of it hit oil. We thought the exuberance was a little bit too much with optimism about the vaccine. Things have calmed down a bit, and I think the OPEC Plus decision to gradually put oil back in the market is helping on the oil side, but undoubtedly there's more of the curb your enthusiasm was really about the title that we took, because we thought that most commodities got a little bit too frothy as a result of optimism on vaccine penetration too early in the year.
Which is kind of what you were saying about copper, that too hot to handle. When do you want to be buying copper here? Like, what's going to trigger some sort of sell-off in prices, and then when do we hit even higher levels?
So it's hard to know. We think that the buying that's associated with typical pre-Chinese New Year may cause a dip. It's hard to know what the financial flows are going to do from one moment to the next. We believe there will be a dip because the supply-demand balance doesn't warrant where the price is today. The price would be, factoring in a drawdown of inventory. We're still seeing a surplus in the copper market. We think that surplus will be disappearing by the middle of the year. So we are, much more looking forward to a dip before the middle of the year, and then a continued price moving upward to the $8,000 level by year end.
Ed, Alex and I talked to Michael O'Leary from Ryanair the other day, and he was painting a very positive picture for next summer in terms of the recovery for aviation. Do you agree with him that it's going to be that positive? What do you see happening with jet fuel? How does it compare with other distillates, diesel, for example?
So we are not positive jet fuel, and not for a whole. Only part of which deals with your first question, or your question about travel. Obviously, there are people who have pent-up demand for travel. Obviously, travel will be there. Business travel, which is a very hefty chunk of front-of-the-plane travel, is not likely to be restored to anything near where it was in 2019 by the middle of this year. But there are two other factors that are impacting jet demand and why we are bullish diesel versus jet. The second issue, besides the travel, is really the jet engine story. So we're seeing very inefficient jet engines and aircraft carrying those engines being retired from the fleet. They're not going to come back. We have engines now that don't need jet fuel on the runway. They're using electric power on the runway, and they don't burn as inefficiently. That is going to be that efficiency gain is also a hurdle to overcome. And then thirdly, we have a movement towards sustainable fuel by large chunks of the airline industry, including by the members of IATA as a whole. Sustainable fuel will be eroding a chunk of the jet fuel demand as well. So we don't think jet fuel demand is going to recover anytime soon. And by anytime soon, depending on what happens with more efficiency gains on jet engines, it may be that we're seeing the peak of jet fuel. At least among fuels, we would have jet fuel peaking long before gasoline.
Wow, so that's a call, which leads me to what do you do as a producer? We have a chart up there that shows U.S. production. Ed, how are they going to handle what we've seen? They're pretty under-hedged, but we've seen a huge flattening of the back end of the curve over the last couple of weeks. What's going on there?
Well, I think part of that flat end of the curve flattening is a function of the hedging activity that took place when oil got 2 rounds of upward movement. We think they are going to continue to, and they're going to continue to add rigs. And undoubtedly, from a global perspective, we are much more bullish Brent than we are Dubai. We're having heavy crudes, sour crudes coming back into the market, maybe month by month, given what OPEC Plus has agreed to. And we're seeing a kind of slowdown, if not a continuing decline, on the availability of light sweet crude. So even as we have Libyan crude coming back into the market, and the Libyans added 800,000 barrels a day from the beginning of November to now, we have Brent moving into backwardation. That's demand, and the demand for the light sweet crudes like Brent and like WTI are what they deliver. They deliver gasoline. They deliver petrochemical feedstock, and petchem feedstock is really high on the demand side.